Welcome to a special bull and bear episode on Your Finance TV. In recent months, the market has shown a bearish attitude towards China, with headlines fueling negative sentiments like China on brink of deflation again reveals still weak rebound. However, is the situation as dire as it seems? We've invited two brilliant finance experts with us, Pelosky and Jeff Huge, to discuss the bull and bear cases. Welcome to the show, gentlemen.
Great to be here.
All right, let's start with you, Jay. Jay, in previous shows, you've mentioned that media coverage may be contributing to the bearish sentiment towards China and that the data actually suggests a more positive outlook. Could you elaborate on why you believe the data is pointing in the right direction despite the negative media coverage?
Sure. Happy to start off, Scott, and great to debate with you once again, Jeff. So look, I think it's very clear to anyone who's been even remotely paying attention that the one thing that the political class in the U.S. can agree on is to bash China. And so our newspapers, our media, our TV, et cetera, are all filled with stories about how China's struggling and China's problem and China is a threat. And I'd say the thing that really caught my eye recently was The Economist magazine, which many are familiar with its cover and the view that economist covers are contrarian indicators. In other words, when The Economist puts up something like oil, for example, is a great one where they said, the end of oil and oil spiked, or, the other examples that I can't really come to mind right at the moment, but the ones that relative to China that do come to mind or are within the last month or two, China was the cover story or the cover picture for back-to-back Economist covers. So not just one contrarian indicator, but two back-to-back, suggesting that China's economy is in trouble, that China's political class maybe doesn't even want to stimulate its economy, and all this kind of stuff that would make you think that clearly, China must be in recession, right? Growth must be negative. That clearly PMIs must be below 50 for manufacturing and for services. And this is where the gap between media coverage and economic reality is really stark. So to begin with, China's economy is growing at roughly 4 to 5% per annum. Now, let's keep in mind that this is an economy with a population of over 1 billion people and is the second largest economy in the world behind the United States. Now, the U.S. is happy if it grows at 2%. China today is growing at more than double the rate of the United States. The PMIs in China are above those of the United States, with the most recent manufacturing and service PMIs coming in above 50. The US manufacturing PMI remains below 50, which is the boom-bust line for expansion. The US PMI for manufacturing has been below 50 for almost 3 years, the longest streak or has been declining, sorry, not below 50, declining for almost 3 years, the longest streak by far in history. And so to me, this just sets up a real opportunity for what we are calling and have been calling for the last, say, month or so, the single best risk-reward trade in the global markets between now and year end.
Jeff, any thoughts on those?
Well, I would say it's a pretty well-defined time frame, so we'll know in the fullness of time, right? But one of my personal heroes is a guy by the name of Paul McCrae Montgomery. Paul is now deceased, but he established a 50-year career as a cycle analyst on Wall Street. One of the great indicators that he introduced, Jay mentioned, and that's the magazine indicator. Now, Paul's work was more focused on when a kind of an everyday news magazine like Newsweek or Time starts making references to, extremes in the market. That was usually a contrarian indicator. Now, I haven't looked at the economists per se as being, their track record of their covers. I know that there have been a few that certainly line up exactly with what Jay's saying. So I don't doubt that this could potentially be an issue. But I would just point out that China topped in 2007. Okay. So basically, the market has been in a long-term secular decline for the last 15 years. It subsequently bottomed post that. I should say its bear market bottom was about a year later in late 2008, early 2009. Now, over the past 10 years, the market has basically gone nowhere. The 36-month moving average is essentially flat. The market has been kind of in a coiling pattern where it's been making a series of lower highs and higher lows. Now, that could potentially, amass enough potential power, if you will, to push above or below one of those trend lines. And my suspicion is just directionally looking at how the market is trading in China, not adjusted for currency. I would say that the downside looks more probable to me than the upside. Although, it's a coin toss at this point. So you certainly couldn't rule it out. Now, as for growth is concerned, I don't think China has to go into recession. I think it's very doubtful that they will go into recession. I mean, as Jay pointed out, they're growing at multiples of what the West is growing at. And I think it's really more a function of that growth is contracting dramatically. We can look back 10 years ago and growth was 6-7%. So, it's a rapid decline now is what we're seeing. And I don't think that they're going to get back above that 5% level. I think it's more likely that growth continues to struggle and move closer to the 4 and below 4% level longer term. And there's a couple of reasons for that I think stand out. Number one, real estate as a component of their economy has been literally the largest creator of wealth in China in the history of the country. And so what we've seen over the last decade or so is a dramatic fall off in construction, demand for housing, and a lot of these companies, their largest real estate development companies, including Evergrande and more recently Country Garden has made the news. These companies are effectively bankrupt, right? They have unrepayable debts. And some of those debts, in the case of Country Garden alone, are $193 billion US dollars worth of debt. It can't be repaid. And most of the projects that Country Garden developer was involved in are outside of China. So the government can't really even help them. The biggest one is Forest City, which is another ghost city that was built in Malaysia that is basically empty. You've got basically a facade of a city that will never be completed. They sold, I think, took deposits on 90% of it, and they completed maybe 10% of it. So, I mean, it's a completely defunct project. There's hundreds of those all over China, not specific to Country Garden, but specific to many other developers. And so I think one of the issues at hand are job creation is going to be impaired for a long time, okay? In fact, youth unemployment is perhaps the worst of any country in the world. Maybe Spain still a little bit better, but 25 and under category of employment is now unemployment's 21% basically. Now, I would say that employment trends are stable for the 25 to 49 class, and so this cohort of consumers in China, are gainfully employed and spending money when you're in the developed cities, certainly not in the rural areas. But the biggest issue there is, they're largely government civil service jobs. That's the largest employer in China. And civil service is now laying off positions and they're not hiring. So, we've got a situation where unemployment trends could creep up and become a problem for China in the, not in the next 3 months, but in the years, maybe several quarters ahead, I think that could definitely be an issue. And then the final thing that comes to mind is simply that foreign direct investment was largely responsible for the amazing growth that China saw from around 2003 up to around 2013 or 14. Okay, when we really started to see things roll over, and I think foreign direct investment is likely to be curtailed dramatically. Certainly, U.S. corporations aren't going to be making the investments that they had been in the past. And the fact that we're reshoring a lot of manufacturing to the U.S., perhaps over the next 3 to 5 years, this is going to be a steady wind in their face. So, with respect to the next 3 months, I don't think any of these trends are necessarily relevant. But I think the longer term case against China, and most disagreements between economists, market strategists can be summed up with time frame, right? My time frame would be a little bit longer in terms of the bear case on China. With respect to a potential, a bounce off the bottom, certainly anything's possible. I wouldn't rule it out.
Okay. Now, I'll direct this one at you, Jeff, so we can take a little bit of turns and back and forth. But how is China's relationship with other countries, such as the United States, going to impact its economy?
Well, I think that's a really big question. From a big picture perspective, I think there's been a hardline shift in government priorities, right? In foreign policy priorities. And those have shifted from economic policy toward really military policy. I think investment in redeveloping, and modernizing their military in China has been probably the largest priority that has been front and center for Xi and the current, Politburo. I think from a standpoint of the implications for that on growth largely depends on what China intends to do with that. We've been showing a chart in our newsletter dubbed the Indo-Pacific powder keg for some time. And it shows that, naval military activity in the South China Sea is as high as it's been since World War II. And in the Indo-Pacific region, perhaps as high as it's been since the Battle of Midway. Right now, I think that China is probably tiptoeing around the idea of potentially putting in place some sort of a naval and aerial blockade of Taiwan, taking advantage of other geopolitical hostilities in the world. I think that there's certainly a possibility that China and Russia are colluding in order to circumvent the West in some way, or at least bog them down in Europe, while both Russia and China stretch to achieve certain independent, mutually exclusive foreign policy objectives. In the case of China, there's no doubt that Taiwan is front and center. It's been discussed repeatedly. And while most military experts do believe that it could be years before China has the military prowess to successfully invade Taiwan, that may not be what they want to do at all. What they may want to do is just control Taiwan, control the supply of semiconductor chips. That is the center of the geopolitical chessboard. And 70% of the world's chip production comes out of Taiwan Semiconductor, the fabs in Taiwan. And so I think there's less of a risk that China has a hot, kinetic military strike on Taiwan, and a greater probability that they create a blockade of sorts and disrupt international trade of semiconductor chips. So that seems to me to be something that could be a significant impact to growth economically for the world, but especially for the US and China.
And Joe, you actually wrote in your musings this week, which you put out weekly, on the geopolitical risks. What do you think on this question?
Yeah, no, as appropriate for this bull bear debate, I'll take the other side of that view, times about 10. Look, the most important geopolitical relationship in the world is the relationship between the US and China. And as I started out with my comments, the one thing the political class in the US can agree on is, we need an enemy, and China is that enemy because Russia has proven itself in the Ukraine to not really be much more than a military paper tiger. And so it's appropriate, as Jeff suggests, to pay attention to China and the relationship between the US and China. And there, I think the news is actually getting better. So, and my evidence to make that claim is quite simple. We had a bipartisan group of senators in China last week. They met with President Xi. They met with the top leadership in China, and they prepared the way for a meeting between President Xi and President Biden in the United States next month on the sidelines of the Asia Pacific Economic Cooperation meeting that's going to be held in San Francisco. So that's a very positive sign. And again, virtually no attention paid to it. No one seems to be aware of it or care of it, but it's a fact, at least the fact of the meeting between our senators and President Xi, and the signs that President Xi will actually travel to the United States next month and meet with President Biden. And so I think that's a suggestion that China does not want to rock the geopolitical boat, does not want to contemplate a hot war in Taiwan, much less a blockade of Taiwan's ability to export semiconductors, which would be pretty much an act of war, and I think would be seen as such by Europe and the United States, given the importance, as Jeff suggests, of semiconductors in modern economic activity. And so, I would also point out that it's the U.S. that has been pressing on China and limiting China's ability to obtain high-end semiconductors. It's not China doing that to Taiwan or to us. It's us doing that to China. So let's be honest about who's doing what in this particular area. But I want to take a moment and go back to Jeff's comments about the long bear market, as he puts it, I think 30 years. Morgan Stanley just came out over the last several days with some interesting history of bear markets and bull markets in China, and pointed out that the last two big bear markets, as they saw it, in 1999 to 2003, and in 2007-08, China fell about 60%, Chinese equity. The most recent bear market, 2021 to 2022, Chinese equity again fell 60%. Morgan Stanley went on to note that the recovery from these bear markets, as again they saw it in 03 and 04, and in 2008 to 2010, were over 100%. And the current recovery for Chinese equity, the current recovery for China in the low of October of last year has been 20%. So they, like us, see significant upside for the Chinese economy. And I'll also note, Jeff talked about the property market. And this is, in my view, the epitome of, talking head type mentality. The idea that the property market in China is going to be a reason for people to not buy equities is, I just don't follow the logic. It's been something that's been going on for several years. It's been intentional. China has wanted to bring the property market kind of back to earth. It was a area of intense speculation. You may recall, or some of your viewers may recall, the 3 red lines in the property market designed to cool it off. That has occurred. In addition, the Chinese government put significant pressure on its tech entrepreneurs over the last several years. That has also been concluded. And you have a situation, Jeff talked about foreign direct investment. You have a situation where China has massive savings, massive, truly massive. 33% of GDP is the estimate for China private sector savings. That compares to a fraction of that for the United States. And so to us, the idea that the property market, look, the reality for those, and I think, Jeff, you have on your own documents, you'd say price matters or price tells or something like that. Let's be honest. The price of China, Evergrande, or the other major real estate developers in China that are going bust, the price on their bonds is pennies on the dollar. Their stocks are down 95%. Okay, we own in our model portfolio an Asia high yield ETF, KYHB. It's actually outperformed the Barclays Ag this year on price alone, not to mention the near 10% yield that it pays and has paid and continues to pay. And it has about a 20 to 30% allocation to China real estate. So the idea that China real estate is going to be a problem for Chinese equities going forward, I think just, flies in the face of reality that it's a 2 or 3 year old story that is already fully expressed in the price. And so I just end on 2 points. One, the valuation discount for Chinese equity versus the US is at an all-time wide. In other words, it has never been in the last 20 years since data has been collected, Chinese equity has never sold at a more significant discount to the US than it does today. Second point is that August, 2 months ago, saw a record foreign selling of Chinese equities, followed up by more foreign selling in September, to a point where foreign investors today are now as underweight Chinese equity as they have been since the COVID low back in 2020. Again, to our point, all the bad news is in the price. That's why it's the best risk reward opportunity out there. The bad news is in the price, record discount on valuation. Everyone who wants to sell has sold, record foreign selling. Bears talk about property woes when price is telling you it's already fully in the price. This stuff is all already zeroed out in most people's portfolios if they hold it at all. And so I think there's really, an opportunity to look at the media and some of the more easily at hand kind of complaints about China or problems with China, as opposed to kind of really digging in and understanding what has priced in Chinese assets today. And that's why we see it as being the best risk reward opportunity currently available in markets today.
I might be flogging a little bit of a dead horse on this one. Like, obviously, the media covers the Chinese and Taiwan tensions. There's also obviously India and China have tensions as well, much to a lesser degree for different reasons. But I'm curious, Jay, to know if you take any of these factors into account when you're making your forecast for China, and if there's any particular stocks or trades that you're looking at in China.
Yeah, we most certainly do. I mean, we're a global macro shop. I've been doing global macro work for 25 plus years, going back to my days as emerging market strategist at Morgan Stanley in the early 1990s. And so, yes, we absolutely do pay attention to it, but it's not the main driver. It's noise for the most part, and occasionally turns into signal. And I think we've debated earlier already the noise versus signal. I think Jeff sees some of this as signal. I see it very much as noise. I mean, what we're focused on really, and why we talk about the time frame such as we are, the short, Q4, Q1 2024 opportunity in China, is in large part because a year ago, China was deep in the most intense lockdowns to deal with COVID. And that suggests two things, which we see as catalysts to create a dynamic where there will be increased buying of Chinese securities. The first is that the year-over-year comparisons will be extremely easy in China, right? So we're going to see all sorts of big numbers coming through in terms of year-over-year comps. We already saw last week, which was China's Golden Week holiday, not only massive, like 100% up year-over-year kind of results for commercial activity during the holiday week as tourists and as Chinese people, took vacations, but also up versus 2019, which, again, here in the US, we're still struggling in several industries to get back to the 2019 levels of economic activity. And then the second point that we would make is that history shows, and history here being the US and Europe, history shows that it takes about a year for consumer confidence to kind of come back fully post-COVID. And there too, we're going to be coming up on that year anniversary in the next couple of months. So we're looking for consumer confidence in China to pick back up. It's very depressed, no argument there whatsoever. Consumer confidence is very depressed. You look at property, as Jeff said, demand for housing is low. You look at any kind of consumer confidence, polling in China, such as it is, very, very low. But we expect that to pick up. And we also know that the government, we call it drips and drabs of policy stimulus. The government is working directly to stimulate consumption in China and to structurally reboot the economy away from, as Jeff suggested, go cities and property development and exports, which was the old China model, in large part because they didn't have the consuming power. The people were not wealthy enough. Now they do have that consuming power, and they do have that massive savings. And so there's an effort underway to stimulate on a cyclical basis consumption, and then on a structural strategic basis, reposition the economy to be leaders in the industries of tomorrow. And where you see that really playing out is clearly in the renewable space, in the electric vehicle space, in the electric vehicle battery space, where China is acknowledged as the world leader in all of those segments, way ahead of the United States and Europe, and to a point where Chinese automakers such as BYD, which some may know since Warren Buffett has a pretty big stake in it, BYD is now growing its exports and its sales of electric vehicles in Europe to in a considerable fashion, taking market share, very, very aggressively. So, the idea that, again, China is moribund and China is struggling doesn't fit with the reality of China as a global leader in solar and wind, in electric vehicles, in battery production, et cetera, et cetera.
Jeff, any trading opportunities you see in China on the back of everything that's happening?
Well, we've actually had our eye on this internet ETF, KWEB. I think that's one that Jay follows as well. And, it's really just not, the price action has not been such that it's, really front and center for us right now. It's a name that's been on our radar screen. I think it's very bombed out. It's going sideways. Everything Jay said might be right. And if it is, then that stock will take off. It will lead the way out. So far, it isn't. So, my suspicion is it's going to have to do a lot of work in the next 3 months to change my mind based on the price action alone. Now, it could all change overnight. Some announcement by, Chinese regulatory officials or something else could totally change that. But if we got a breakout above, the March highs, I believe, that would get our attention. We would definitely consider that as being, the tip of the spear for a trade. But, like I said earlier, I'm not really focused on the next 1 to 3 months with respect to China. I think the structural story in China has been ridiculously bad for the last 18 years, as we mentioned. If you look at the Shanghai Stock Exchange Composite, okay, as an index relative to the S&P 500, it made a new all-time record low a month ago. So, granted, we bounced off that low, but there's a lot of work to do relative to the S&P 500 or other options. I'd also say this. We track the 15 largest global stock indexes, okay, country indexes. And China has been ranked in the bottom decile of those 15 largest national indexes for the entire year. Really for some time, possibly the last 2 years. I don't know off the top of my head, but certainly for the last year. And what's really interesting to me is the September data was even worse than the August, July, June period as well. So, I mean, it basically put in a new relative low. So when we look at relative strength of the Chinese index, compared to anything else in the world, it is the worst performer. Now, that speaks directly to Jay. He's obviously got a very contrarian view here, and he might be right. I don't discount that possibility. I'm open-minded to it, but it's impossible to say, right? There's no evidence that this is going to happen. You're simply buying something that's very, very cheap. It could very well be a value trap. And so, our strategy is to wait for markets to express that leadership change. We want to see some evidence of change. We don't need it to get to the top. What we do is we need it to move out of the bottom decile or the bottom quintile. And as we start to see some evidence of relative strength improvement, then that would take China and move it up in the ranks. But right now it ranks as poorly as could be on a global basis.
Now, Jeff, before you touched on the youth unemployment in China, and I'll direct, this is a good question for you on this. So how might China's shifting demographics, particularly the aging of its population to go the other way on the age frame, affect its economic growth and investment landscape?
Yeah, so I was in China in 2007 and toured basically the entire continent over about a 3-week period of time. And the guides that I was with were locals in every area. They're very fluent in English and, had a strong desire to kind of get to know us and develop a relationship. And so I spent a lot of time, because I'm in the business, trying to understand the social and economic dynamics throughout the country. I mean, we were everywhere from, Shanghai and Beijing to, lesser cities in the Guangdong province, right? The very rural areas. And so we got, within 400 miles of Vietnam. I was very, very rural there. And so, the people that we spoke with, in fact, I'll even say this, we spent an entire day with a family in their home. They taught us how to play mahjong. We had just a great relationship, got to know them and whatnot. And so, what was clear to me is that when we were in the city, there were very few children relative to adults. There's a one-child policy that had been in place for 30 years that was widely enforced in the major cities, right? And so I think that is a big problem for China because, they're hoping for this migration of people out of rural China into the center cities, the strong cities. And there's 30 or so giant mega cities with populations of in excess of 20 million people throughout China. So these are very big, very populous areas where, there could be job creation. The problem is that job creation was largely based on civil service and real estate development. And that isn't happening anymore. In fact, projects, these ghost cities, there's hundreds of them throughout China, okay? They're not going to make any more of them, so they're not going to create those jobs, okay? And so that's a growth, that's a wind in your face, not in your sail, right? So it's a headwind. The problem for demographics is you're not replacing your population, right? And if there are no jobs in the cities, then we basically have a situation where you've got rural families, which tend to have more children, typically 2 to 3, and they're not necessarily penalized because a lot of these are farm families or laborers, and so they need more laborers in the rural area, for more agricultural work, but also clearing of timbers and things like that. I mean, there's all sorts of things, digging, pushing mud around, that sort of, manual labor. So they're not penalized for that. And so I think, there's certainly less population growth in China than, say, the US right now. But I think globally, population growth is on the decline and has been for many, many years. And so, we're going to run into this situation in the developed world. And I think China is definitely not an emerging country anymore, the second largest economy in the world. They're still developing, but they're pretty developed in the larger cities. And I would just simply say that they've got a problem with demographics fueling growth going forward, especially if you're going to be dependent on consumerism internally to drive that growth and not be focused on exports and imports, which, by the way, have been negative for the last couple of years. So, I guess when I think about that question, not really having a lot of data at hand for it, I mean, empirically, that is, I think we could say anecdotally, if you're not growing your population, you're probably going to run out of consumers at some point. It's a long-term sort of growth demographic shift, probably a 20-year problem, not a 2 to 3 month problem.
Okay, Jay, what do you think on that?
Well, I mean, Jeff's absolutely correct that population growth is a big driver to economic growth, together with productivity, right? And so Jeff's talking about, people cutting down trees and pushing mud around. And I think that the whole point about what China's trying to achieve, as I mentioned earlier, is, move up the kind of value add chain and drive the economy through the industries of tomorrow, today and tomorrow. Thus, as I spoke at some length about renewables and clean energy, China is a global leader in probably what is going to be the biggest driver to economic activity across the world in this decade going forward. Right, the need to fix the climate mitigation, et cetera, et cetera. China is a global leader. China is seeking to move up the tech chain, right? It was the old President Xi, I think, got himself in a lot of trouble with the rest of the world when he talked about China made in China 2035, where he set out as an objective China having leadership roles in the industries that will drive global economies over the next decade or so. And I mean, I don't really see the problem in that, right? That's what all economies should do, particularly ones that have aging populations and declining populations. They need to move up market to continue to grow. And that's where you could argue, as Jeff does and as bears do, that this is a negative for China, as opposed to the bullish take or the more positive take is that this is driving China to increase its productivity and focus more on the private sector, thus the kind of dampening down of tech spirits in China. That has now been removed. The government has said, hey, we recognize, much as here in the United States with AI, right? There was talk when President Biden came into office of antitrust against big tech. Well, what's happened since then? AI has happened since then. China has happened since then. And now we don't hear so much about antitrust because the government needs big tech to compete. Same with China. And so that issue has been removed. And that leads me to what Jeff was talking about, namely KWEB as an area of opportunity. That is, in fact, one of the two ETFs that we're using to express our view on China. And it's very clear, at least to us, that tech is the leading sector. And interestingly enough, even during the big backup in interest rates over the last 6 weeks or so, tech has still been the best performing sector. And guess what? KWEB is outperforming the US over the last 1 and 3 months, suggesting to us that while it maybe has not yet meet met Jeff's, kind of level as he laid out how they look at it in his firm. Maybe has not yet met that level, but to us, what's interesting is that clearly tech is the leader, has led even through a massive backup in rates. We don't expect another massive backup in rates. And within tech, China tech is actually leading. And so trades at a massive discount to the US, is completely underowned after record foreign selling, is ripe for signs of economic pickup. And I didn't mention, but I should have, that many US firms, including Citibank and JP Morgan, over the last 2 weeks have raised their Q3 and Q4 estimates for growth in China, have raised their estimates for growth in China next year. And so that tech play, and it's great to hear that Jeff is also focused on this as an area of opportunity, potentially, should it meet his criteria. We're already there. And again, risk reward, we think the risk is low, the reward is high, particularly over the time frame we've laid out. And that is how we're expressing our view on China.
Well, gentlemen, I just want to say thank you very much to you both. And one thing that I have learned from this is that we need to have the two of you more on more shows. Great back and forth. Great insights. Thank you so much.
Mission accomplished, Jeff, right? We're going to get
absolutely.
Good
Thanks
stuff.
for having me on, Scott. It was a pleasure to be here.
You're welcome. All right. And for everyone else out there, good luck investing.